Hello, so my name is Shawn Moodie. I'm a credit consultant. My company is Moodie Bluez Consulting, and I specialize in helping people. My company, we specialize in helping people either establish, build, repair, or maximize both consumer credit and also business credit. And I've been in the financial services industry for going on over 2 decades, and I'm dating myself a little bit. But in any event, I'm very passionate around financial literacy. And the goal for today is to really explain what credit is, do a deep dive on why it's important and why it really should be important to you when you think about inflation and high interest rates. Having good credit and understanding how credit works can really give you an advantage in the marketplace and be a game changer in giving you the ability to achieve whatever financial goals you may have, whether it's home ownership, starting a business, or any other financial goals you may have. So let's get right into it. So what is credit? So credit in its most basic form is the ability for a consumer to purchase a good or a service before actually making a payment, with the understanding that you're actually going to make that payment at a later or future date. Okay. So when you apply for a credit card, you apply for a loan, you whether it's a student loan, an auto loan, lenders want to understand if you're going to look to borrow money from them, they want to understand how credit worthy you are. And that's where the credit score comes in, right? So how likely are you to actually pay that money back? So if I loan you $20, what's the likelihood of you paying me that money back, right? In its most basic form. Now, if you've got good credit, and we'll certainly do a deep dive on that, but if you've got good credit, then lenders will see you as lower risk. So the better your credit score, lenders see you as a lower risk, meaning the more likely you are to pay on time and actually to fulfill your financial obligations, right? So better the credit, better opportunities, better interest rates, more loan approvals, okay? Poor credit, that means you're a higher risk. So if the banks or lenders see you as a higher risk, you're going to have more difficulty in getting approved for loans, more difficulty getting approved for things like renting an apartment or even purchasing a home. Um, Rates are going to be higher. So as an example, even your car insurance, auto insurance, a lot of people don't know that. Yeah, yes, your auto premiums, auto insurance premiums that you pay are based on your driving record. But in addition to that, it's also loosely based on your personal credit score as well. So you want to make sure your personal credit score is in good shape, because when you think about it, your personal credit score or your consumer credit score is really your financial reputation. So moving on, so FICO is the most widely used credit score across the country. It's used by 90% of lenders and banks across the country. Now, FICO, which stands for Fair Isaac Corporation, was founded back in 1956, where they first developed the first credit scores to help lenders assess risk. Right? How risky are borrowers when they're looking to apply for and get loans or even credit cards. And in 1989, they released the FICO score as we know it today. Okay. And there are 5 factors that go into your FICO score. And again, these factors have not changed in decades. So there's no excuse for you not to know what the 5 factors are. So the 5 factors are as follows. The highest factor at 35% is going to be your payment history, meaning you want to pay your bills on time. So you have a credit card, you have a mortgage, you have a student loan, you have an auto loan. You want to make sure you pay your bills on time. Just one late payment can drop your score between 90 to 110 points. So you want to make sure that you pay your bills on time. And this is 35% of your score, the biggest impact on your credit score. And again, this is a factor that you have total control over, right? You pay your bills on time, you don't have to worry about this. The next factor at 30% is what's called credit utilization, which is a fancy way of saying the amount you owe. And this is particularly important when you think about credit cards. So when we talk about amount you owe or credit utilization, so as an example, let's say you have a credit card and it has a $1,000 credit limit. Generally speaking, most banks will tell you you don't want to carry a balance higher than 30% utilization. So 30% would mean you're carrying a balance of $300 with the example I'm sharing. You have $1,000 credit limit. Okay, so you want to keep your balances low. Now, although most banks tell you 30% is a sweet spot, the actual sweet spot is 10%. So that means for every $1,000 of available credit you have, particularly with credit cards, you want to keep your balances, if you're going to keep a balance, less than 10% of the limit. So in this case, it'd be less than $100. Now, there's nothing wrong with paying your cards off in in total, 100% every month, right? That's called a transactor. You have transactors and you have revolvers. Transactors pay their entire balance off at the end of the month, which the FICO score loves that. And lenders love when you show that you have the ability and you're showing behaviors of paying off your balance in full at the end of every month. Now, if you're a revolver, that means you're carrying a balance. You're carrying a balance at the end of every month, and if that balance continues to grow month over month, that could actually drop your FICO score. So again, this is 30% of your score. So now the top two factors that we just shared is 65% of your score, and both of these factors you have control over. The third factor at 15% is based on the age of your accounts. So the FICO model looks at the age of each individual account. So let's say you opened an account 3 years ago. That means the age of that account is 3 years old. And then it looks at the average age of all your accounts combined. All right. So if you opened one account 3 years ago and you open another account 1 year ago, that means the average age of your accounts, if you do the math, the average age of your accounts is probably about 1.5 years old, right? It's going to take the average of all your accounts. The general rule of thumb is the older the average age of your accounts, the better, because lenders like to see that you have experience using different types of accounts. The sweet spot is really at least 6 years of the average age. Now, obviously, if you're just starting to build your credit, that's okay. You're not going to have 6 years right off the bat. But again, you want to make sure when you open accounts, you use them appropriately, use them responsibly, and keep them open. All right. The next factor at 10% is based on what's called inquiries or new accounts. So every time you apply for a new account, it creates what's called a hard inquiry. All right. And this equates for 10% of your score. So a hard inquiry stays on your credit report for 2 years, but it's only calculated in your score for 1. So if you apply for that Target credit card, let's say you're in Target and they say, hey, would you like to save 10%? And you go ahead and apply for that card. Whenever you authorize a lender or a bank or a store to pull your credit, it creates that hard inquiry. And again, that hard inquiry stays in your report for 2 years, although it's calculating your score for 1. Now, too many inquiries in a short period of time is not a good thing because that can drop your score. Again, this is 10% of your score. So you really want to be selective when applying for new credit. And the general rule of thumb is only apply for credit when you need it. Okay, so if you're applying for a ton of credit in a short period of time, that can definitely reduce your score. The last 10%, the last factor at 10% is based on types of credit. Now, there are only 3 types of credit that report to the credit bureaus. That's going to be a mortgage. It's going to be an installment loan. So an example of an installment loan would be like a student loan or a personal loan or even an auto loan. And then the last type is going to be revolving, which would be like a credit card. So if you have one of those accounts, if you have an account in each of those buckets, each of those 3 buckets, you're now giving yourself an additional 10%. All right. So those are the 5 factors. That's the full 100%. And again, you have control over the highest 2 factors, which is the payment history and the credit utilization. So keep that in mind. So what does your FICO score mean to lenders? So the FICO score goes from a low of 300 all the way up to 850, right? So a good FICO score, generally speaking, is going to be a minimum of a 680 to 720. If you got a 720 to a 780, you have what's called a good FICO score in most lenders' eyes, meaning that you've demonstrated with the experience and the way that you've managed your accounts and by paying on time, that lenders see you as low risk, meaning that you're seen as a good borrower. So you're more likely to get not only approved, but you're also likely to get better loan terms, better interest rates. Okay. If you have typically a 760, 780 plus, again, the FICO score only goes to 850. That's the highest you can get, but you don't have to be at an 850 to get the best rates and the best terms. If generally speaking, if you're over a 760, 780 plus, you're going to get the best terms, whether you're looking to purchase a house, purchase a vehicle, get a credit card, get a personal loan. If you're in that 760 to 780 range, generally speaking, you're going to get access to the best rates. Okay. And you really want to monitor your score, and the score fluctuates, right? So if I were to do a survey on how many people check their bank account, how often you check your bank account, typically when I do a presentation and I ask for a show of hands, usually everyone raises their hands if I ask, how many times have you checked your bank account in the last week? But if I ask people how many times have they checked their credit report, even over the last month, typically it's less than 50% of hands go up. And actually that mirrors the actual national average. The national average is actually less than 40% of people that check their credit reports regularly. And believe it or not, there's more than 30% of consumers across the country have never checked their credit report ever, which is not a good thing. And when you think of the technology that we have available to us today and the age of the internet, there's really no excuse for you not to know exactly what your FICO score, what your credit report looks like, and what your credit score looks like. Because again, this is your financial reputation. Did you know the average cost of bad credit over a lifetime, and by the way, this is a very conservative number, is about $250,000. So meaning, so if you've got bad credit or if you've got less than perfect credit, you're probably going to be paying higher interest rates, right? You're probably not going to get, you're probably going to pay higher insurance, auto insurance, right? You may have to put down a security deposit on your cell phone, right? If you're finding yourself having to put down a security deposit on a cell phone, or if you are paying, a couple $100 more for the same exact vehicle with the same exact driving record as someone with good credit, then you know that your credit's not where it needs to be. So again, you want to make sure that your credit is in good standing. This can cost you over $250,000 over a lifetime, and again, that's a conservative number. So you want to check your credit report regularly. Now, most people know about annualcreditreport.com, where you can get your report annually. So when the government passed the CARES Act 3 years ago, you now have access to that annualcreditreport.com, your free report on a weekly basis. So again, no excuse not to know what's on your credit report. So you can actually pull your free credit report from annualcreditreport.com on a weekly basis until further notice, as of the date of this presentation. Okay, so annualcreditreport.com. Experian.com also gives you an option to pull your Experian credit report. There's a free option. Now, if you want to get access to all three reports with the actual FICO scores, you actually have to pay for that. There are other apps out there as well. So most of the major banks out there also offer at least a snapshot on what your credit report looks like, or they may give you at least one credit bureau with the FICO scores as well. So check your local bank apps. All right. And Credit Karma. I'm sure many of you are familiar with or currently use Credit Karma, and you'll notice that there's an asterisk next to that. The reason for that is just a couple things. One is Credit Karma, one uses a credit score, doesn't use FICO. Now, remember, I said FICO is used by 90% of lenders. And by the way, if you're ever going to get a mortgage, it's used by 100% of mortgage lenders. Now, Credit Karma uses a lesser known scoring model called Vantage Score, in particular Vantage Score 3.0. Now, Vantage Score 3.0 was designed or developed by the three bureaus in concert to compete with FICO. Now, remember, now these are not government agencies; these are for-profit private entities, right? And FICO is a publicly traded company as well. So the bottom line is they wanted to compete. So it's a lesser known model. So when you're looking at your Credit Karma score, again, it's based on Vantage Score 3.0. So when you go and look at your score and it says 750 and you're excited, then you go to the auto dealership and they pull your credit and it says 680, and you're trying to figure out why is that. That's because you're not comparing apples to apples. You're looking at a Vantage Score 3.0. In addition to that, the reason that Credit Karma is quote unquote free is because they have partnerships with a number of different lenders. So when you get all those offers that you see that pop up that are quote unquote tailored towards you, that is how Credit Karma gets paid. And so just be very, very mindful when using that site. They do a lot of data mining as well. And so, if you want to compare apples to apples, you want to use the most universally used score in the country, you want to really use FICO, which is not used with Credit Karma. So let's look at the credit report in its most basic form. So when you go to annualcreditreport.com or you go to any of those other sites, typically a credit report has 6 sections. Okay, you're gonna have your personal profile section. That's gonna have your name, and depending on what type of report and where you pulled it, it may show your date of birth, or it may have partial information for things like your date of birth, your social security number, your home address. There's going to be a credit summary. It's going to show how many accounts you have open, how many are closed, how many derogatory or delinquent accounts you may have. Obviously, the goal is 0, right? If you're going to pay your bills on time. If you have any public records, the only public records that are going to show on a credit report is going to be a bankruptcy. Okay, so any other type of public records like a tax lien or a judgment, that's not going to show on the main credit bureaus, Equifax, TransUnion, and Experian, but it will show on other secondary bureaus such as LexisNexis, as an example. All right, so the bottom line is you want to try to avoid public records at all costs. It's going to show your account history. So your account history is going to list all the accounts that you have financial relationships with. So if you have a student loan with the government, it'll show Fed loan. It'll list the loan terms. It'll show you when the loan was when it was opened. It's going to show the actual current balance you may have. It's going to show your payment history. Typically, it'll go back, depending on where you pull the credit report, anywhere from 2 to 7 years. So it can show your payment history. And again, the goal is to have a perfect payment history, meaning you've paid on time. All right. It's going to show that credit inquiry section as well. Remember, we talked about every time you authorize a lender or a bank to pull your credit report, it creates that hard inquiry. So there'll be a credit inquiry section. And of course, there'll be a section that'll show your actual credit scores. Now, speaking of late payments, remember, we talked about 35% of your score being based on what's called your payment history. So in this example here, we're looking at an account. This is American Express. You can see the account name. It'll list the account number. But if you look at payment status, it shows 60 days late. Now, just one late payment. Now, the bureaus or a lender cannot report you late to the credit bureaus until you're at least 30 days late. Once you're 30 days past your due date, then they can report it to the bureaus. Now, one late payment can drop your score between 90 to 110 points. I think that's worth repeating. All right. So if you look at this example, you can see it shows payment status 60 days late. All right. So that means this account has gone not just 30, it's gone 60 days late, which is a much more severe late payment. Now, a 60-day late is like the equivalent of you having a collection, a charge off, a repossession. Bottom line, it's a key derogatory which can do tremendous damage to your score. So again, you want to pay on time. In this example, this shows a late payment, but this also shows an account that's been closed. So if you look at the payment status, it shows this account has been 180 days late. Okay, but it also shows the account status as well. You notice the account status, it says paid and closed. So even though this account is closed, a late payment will still stay on your credit report for 7 years. So I'm going to use a terminology called statute of limitations. Statute of limitations is a fancy way of saying the amount of time that something can remain on your credit report. So for any type of derogatory information, late payments, collections, a repossession, a charge off, okay, those are going to stay in the report for 7 years. For a bankruptcy, if you have a Chapter 7 bankruptcy, it's going to stay in your report for 10 years. If it's a Chapter 13 bankruptcy, which means you're making actual payments, it's 7 years from the date of discharge. And most Chapter 13 bankruptcies are discharged within 1 to 3 years. So you're still looking at close to 10 years anyway. Okay. Now here's an example of a credit report in good standing. Again, you can see the account name. So this account is with Bank of America. You can see the account type. This is a credit card. The account status. This is an open account. It says open. It shows the balance, which right now is at 0. All right. It shows the limit. So this credit card has a $10,000 limit. And you look at the payment status. It says current, never late, which is a great thing. You want to make sure all your accounts are kept current. And ideally, you want it to be in a never late status, meaning you've never been late. One last example here on the left, you can see the Credit Karma app. For those that use Credit Karma, again, I'm not going to get too much into that. We talked about that. Nothing wrong with looking at the credit report, but keep in mind that with the credit score that we talked about earlier, which is Vantage Score. On the right, we have an example of a credit report that is pulled from annualcreditreport.com. Now, in this example, again, you can see the format's a little bit different. Again, with annualcreditreport.com, they're not going to give you your credit score, but you can get access to the actual credit report and your credit history, right? Which is what drives the credit score. Now, why do you want to check your credit report on a daily basis? Well, one thing is there's been studies that show up to 79% of credit reports across this country. So that's 3 out of 4 citizens across the country. There's something on the credit report that's either inaccurate, outdated, or just complete an error, right? And by the way, if there's inaccurate information on your report, 9 times out of 10, this is going to hurt your credit score, meaning your credit score is going to be lower than it should be. So what are some common credit report errors? Your personal information may be wrong, especially if you have a common name like Michael Anthony or Michael Smith, right? There may be a Michael Smith or Michael Anthony in another state that has a similar name or similar social security number. That's what's called a mixed file, right? Your name might be misspelled or an inaccurate birth date. Or there may be an account that's showing that's closed, that has a closed stat that's actually open, or an account that's actually open that's showing that's closed, right? So, or there may be an account that doesn't even belong to you, or you may show an account that shows duplicate listings. So there are a number of different errors that may show up on the report. So again, this underlines the importance of making sure that you check your credit report on a regular basis. How often? And for me, I believe you should check your report at least once a month. So making sure that you have good credit, one of the big things you want to do is make sure you also have a budget, right? So if you're going to be responsible in managing your credit, you also want to be responsible in managing a good budget. So knowing exactly how much money you have coming in every month and how much money is actually going out. And obviously you want to make sure less money is going out than what's coming in every month, right? That's going to ensure that you don't overextend yourself. And certainly if you've got credit cards, loans, you want to make sure you can pay those on time and be able to fulfill your financial obligations. So, and if you have a good budget and you have good credit, now you've really given yourself, that advantage in the marketplace where, again, you're going to get access to those better loan terms, better rates, easy approval for rental, whether you're going to rent an apartment or you're going to purchase a home, lower insurance rates, not having to put a security deposit when you're getting your cell phone, right? So you're going to put yourself in a much better position. Now, what is a budget and why is it important, right? So a budget is really just the estimation of your income and your expenses. Again, and generally speaking, you want to look at it from a monthly perspective, right? So how much money do you have coming in? So think about employment, what other streams of income you may have coming in, and then you want to compare that to your actual expenses. So how much money is going out, right? So bills that you have, any loans you may have out there. And then, of course, what we call the necessities, right? You have to pay your rent, how much you have to pay in gas, your auto loan, if you have an auto loan out there as well. So why is having a budget important? Well, one thing that having a budget helps you do is it helps you actually control your spending. If you're spending money, you have no idea what's coming in and going out, there's much better chance that you're on a path where when you finally figure out how much money you do have going in and going out, it may not be where you want to be, right? So you want to definitely stay on track. If you got any financial goals, having a budget helps you stay on track to reach those financial goals. If you're in a relationship, it can help you with your relationship as well. If you're looking to save money, the best way to save money is to have a budget, right? You want to know exactly where you are so you can know exactly where you're going. It keeps you from feeling financially overwhelmed, right? If you have no idea of what's coming in and what's going out, it can be overwhelming at times. So if you can be very intentional around making sure that you know what your budget is, and if you've got a savings goal in mind and you stick to it, you're going to be more likely to be overwhelmed. And bottom line, it keeps you organized, right? The more organized you are, the better chance you have to reach your savings goals and to actually stick with your budget. So here's a sample budget sheet. You could be old school and use an Excel sheet, which is not necessarily old. So I like to use Excel sheets as well. But then there are also in this day and age, you have a lot of different apps that are out there as well that are very user friendly that you can download on your cell phone, and they're very user friendly in the sense that you can actually import any open accounts that you may have to make it very easy for you to be able to track what expenses you do have. But the bottom line here is whether you do it manually on paper or an Excel file, or whether you're going to use an app, the bottom line is use something and stick with it. So what are the basic fundamentals? So we talked about a budget. So you have your wants and you have your needs, right? A want is something that basically can increase your quality of life, but it's not necessarily a necessity, right? So think about luxury clothes or designer clothes or sneakers, going out on vacations, right? Eating out to a fancy restaurant, right? That's not necessarily a need, that's a want. I mean, it can make life feel better, but again, that's more of a want, not a need. Now, a need is something that is a necessity. It's something that is essential for you to actually live, right? So think about food, water, shelter. You need, right? Whether it's an apartment or you own a home, you have to pay your utility bills. If you don't pay your water bill, what happens? They shut off the water. You need water, right? So that's the difference between a need and a want. And when we're saving, we really want to maximize or minimize our wants and really understand what is the difference between a want and a need, right? And so when you're setting savings goals, you really want to be intentional around how much of your actual monthly income you're dedicating to wants, needs, and your actual savings goal. Okay. Now, believe it or not, more than 50% of Americans across the country have less than 3 months emergency savings. One of the most basic ways to set a savings goal is an old financial rule called the 50-30-20 rule. And it basically says you're going to put aside 50% of your monthly income for your needs, 30% for your wants, and 20% will go to savings. So as an example, if you're making $1,000 in income per month, that would mean you would set aside $500 for your needs. Okay, so think about paying your rent, paying your mortgage, paying your water bill, paying your cell phone, paying your car note. 30% or $300 would go towards your wants. So wanting to go out to dinner once a month, buying your Starbucks coffee, buying that pair of sneakers. And then 20% would go towards savings, which would be $200. All right. And if you did that, again, if you're bringing in $1,000 a month, that's $12,000 for the year. If you save $200 a month, right, you would have saved $2,400 for the year, just in using that 50-30-20 rule. So again, very, very effective. It takes discipline, but it can be done. All right, so with that, why don't we transition to the money management and consumer credit tips? So we talked about the credit report earlier. Main thing, again, check your credit report regularly, right? More than likely there's an error on there, and this is your financial reputation, so you want to make sure that it's reflecting your current financial situation accurately. So check it regularly, okay? Assess your debts. See what debts you have in there. See what debts you have out there, and you want to be very intentional around paying those down. And there are a number of different techniques to pay down debt. There's a snowball technique. There's another one called the avalanche technique. For the sake of time, I'm not going to go into details, but there are a ton of different options to pay down debt. The bottom line is to know exactly where you stand with your debt and have a plan, right? Third is that, as I mentioned earlier, there are a number of different resources out there from a technology standpoint in the way of mobile apps to help you budget your money. So such as one app that I like that I use myself personally is Mint. But there are other apps out there like Pocket Guard. And then a lot of the major banks also have budgeting options within their online banking tools as well. So listen, you've got a banking relationship, take advantage of every resource you have. That's part of what you're paying for. One tip I would share is be wary of requests to co-sign, whether it's co-signing for a vehicle, co-signing for a credit card. I can tell you as a credit consultant, I've seen a ton of horror stories, whether it's co-signing for a friend, a family member, an ex-spouse, a partner, and one person decides for whatever reason they don't want to honor their end of the bargain and honor their financial responsibility. And unfortunately, one person, well, actually both persons, but the person that actually co-signed, now their credit gets hurt, and now they've got bad credit because they were trying to do a good thing, and one person doesn't want to, honor their financial responsibility. So I would just say be very, very wary. Me personally, I don't like to do it. I love my family, I love friends, but I'm not co-signing for anybody. All right. Another good tool I like to try to set it and forget it. So what do I mean by that? So the way that I manage my personal finances is I do a couple things. One is I set up auto pay. So a lot of my bills, I have an auto pay set up where the bills are automatically paid from my checking account, so that I know that I'm going to pay on time, and two, I know exactly what's coming out, and it's something like I can forecast, right? I know exactly what my pay dates are. Now, if I didn't set up the auto pay with the number of accounts that I have open personally, it would be overwhelming. Okay, wait, what does that bill do? It's a little more daunting to manage, and it can be overwhelming. So take advantage of auto pay. You can also do auto transfers from your savings account to your checking account, or vice versa. So if you're looking to save, and you have your let's say you have a direct deposit coming in from your employer, why not do an automatic transfer out of your checking account into a savings account and forget about that savings account, right? That's a great way to save as well. And last but not least, you want to set realistic, attainable goals. Remember that 50-30-20 rule. If you can save at least 20% of your income, your monthly income, and put that aside for savings, you're going to be winning, right? So don't set your goals, make sure they're attainable and they're realistic. The last thing you want to do is set goals that are way out there, and then you're going to discourage yourself, which is what you don't want. And with that, I hope that everyone found some value and some real life tips and best practices that you can apply right now and share with friends, family. And again, the goal really for this presentation was for you to really understand why credit's important, how it ties into budgeting, and how you can leverage both, effectively managing your credit, understanding how it works, and to be able to effectively budget so that you can achieve whatever financial goals you may have. So hopefully you found this useful, and I appreciate your time today.